The other thing I would think about too across Asia Pac, which is very, very important, is food. And what you're seeing now is quite, some of the countries are banning exports of rice. We've obviously seen some pretty terrible floods in China. That area is also a bit of a food basket. So what I'd be starting to think about now is food price inflation across Asia Pacific. And it's a lot more important in Asia Pacific than it is in other parts of the world. So that's also going to feed into Japan. Obviously, a big consumer of rice. And so rice, as one example, is starting to trend higher here. So that's another ingredient on top of the wage price inflation that we're starting to see. And I think that's going to be quite sticky in Japan. So I think they're behind the curve. It's pretty clear everybody else has moved away from zero. They also need to move away from yield curve control.
Yeah, I mean, I take your underlying argument here, but just on the rice in Japan, does Japan import much rice from overseas?
No, but obviously they're a player that can export as well. So the regional prices, most people don't. They're quite particular about which rice they want. But what you find is generally you start to get the boost in prices if they happen to be an exporter as well. And so you're going to see that across the region. Oh, look, I've just picked on one thing there. If you think across the board now, think about food price inflation starting to come back. And that's something that's really just started to re-exert itself again. And again, think about oil, for example. We've just had a big bounce in the oil price. That's going to feed back into those inflation numbers around the world, not even in the Asia-Pacific region.
Can we just swing back to just something that you mentioned in terms of the US curve? What are your expectations there more specifically? Because, in terms of if we do see this inversion peeling off, there's two ways, obviously, that it can happen. You can have, for some precipitous reason, the short end getting absolutely squashed and bought up because maybe the Fed decides, oh, yeah, we're going to start cutting rates. Or the other way around, that we could just see the longer end continue to steepen, like you mentioned. So are you pegging in your head maybe the 10-year sitting at 5, like Jamie Dimon was saying? Is that something that you think is realistic in the medium term now?
Yeah, look, that obviously sounds a bit extreme. You would need much higher inflation, and you would also need the cash rates to start being hiked again. At the moment, look, it feels now you've got quite a buffer in the bond market. You're getting to the end of the rate hike cycle. You're getting lower hikes. This is not just the US. This is every economy around the world. So what you're going to see is, I think, that the households and those that have been putting all their money into cash, haven't really been playing equity markets. So wherever we go around the world, everybody's been talking about money market funds. Everybody's been getting 5+%. Everybody's been very comfortable. They're not willing. And so I think what you'll find now is the investors will start moving out into the front parts of the yield curve and then into the longer dated bonds. So they're starting to do that now. We're starting to see a little bit of that. Short dated bond funds, let's call it 1 to 3 years. And then they'll get encouraged when they start to see material slowdown, which is not where we are now. Everybody for the US is in the soft landing camp, I feel today. We weren't there at the start of the year. We weren't in that camp of a recession. Now we're in the soft landing camp. So we now need to think about the other scenarios because everybody else is there and it's probably priced into the market.